Hi, I'm Brad Foster, financial strategist and manager of the Investment Services Council here at McKinley Carter. We are asked all the time about our investment selection process, and today I want to pull back the curtain a bit and take you through our decision-making process and how we build portfolios for all types of clients. Some of the most common questions we hear are, how do you make investment decisions in today's environment? What's the process for filtering through the sea of information and conflicting opinions about what's next? How do you balance the needs to be disciplined and patient, yet flexible enough to navigate a constantly changing market? These are all great questions, and they capture the challenges facing investors today. At McKinley Carter, navigating these issues ultimately falls to our Investment Strategy Committee, which is one component of our internal group known as the Investment Services Council. The Strategy Committee is made up of 6 senior advisors from around the firm with more than 100 years of combined investment experience, and each member bringing a unique perspective. The Strategy Committee leverages a proprietary process known internally as our decision points. I'd like to give a brief overview of what the decision points process is, how it's structured, and why it was designed this way. Before diving into the specific details of the process, it's important to understand a few of our foundational principles that shape our investment philosophy and help guide all investment decisions that we make. First, in general, we believe that markets are relatively efficient and do a good job of setting prices that reflect all known public information. This doesn't mean that market prices are always accurate or always correct. Rather, it means that consistently knowing whether prices are too high or too low at any given point is very difficult to predict on a repeatable basis. Second, because markets are fairly efficient, the short-term movements in prices are primarily influenced by new or unforeseen information that results in adjustments to expectations. This process of prices adjusting to new information results in highly unpredictable and seemingly random movements over short periods of time. Third, due to the erratic nature of market movements in the short term, we prefer to focus on longer time frames where market performance is more closely connected to underlying economic and market fundamentals. Things like corporate earnings, economic growth rates, interest rates, and valuations. Lastly, even over long time frames, there are no guarantees. Market movements remain challenging to predict, which exposes investors to significant risks if not approached with discipline and a certain degree of humility. We believe the most effective ways to manage these risks are to embrace diversification, focus on targeting opportunities at the broader asset allocation level, and by placing limits on the degree of tactical tilts from our long-term allocations. By applying these principles, our strategy committee is able to make specific tactical tilts, which are simply modest shifts from our long-term baseline allocations when we hold strong, data-driven convictions with the goal of producing superior long-term returns at each corresponding level of risk. In practice, here's what the process looks like. We begin with an annual process of determining our long-term strategic allocations, which represent McKinley Carter's 7 to 10 year outlook based on current conditions. These form our baseline allocations upon which any tactical tilts might be applied. At least quarterly, the 6 strategy committee members independently complete a comprehensive survey indicating whether they see opportunities to deviate from our baseline allocations over more intermediate timeframes, typically a 2 to 3 year time horizon. The survey is designed to incorporate best practices from the theory known as the wisdom of the crowds. The theory is based on research showing that properly structured groups have been found, on average, to make more accurate predictions than any single expert. The survey results are then compiled to assess whether the group's consensus allocations deviate meaningfully from our baseline allocations across a range of key areas such as stock-to-bond ratio, domestic versus international stock allocations, and growth stocks relative to value stocks, just to name a few. If the group's consensus is to deviate from the baseline allocations, these deviations form our tactical tilts and are then represented within our portfolio allocations across the firm. Lastly, in order to limit the degree of deviations that we make from our long-term allocations, we place thresholds around those baseline allocations to ensure we maintain appropriate diversification and relative consistency with our longer-term outlook. We believe that by keeping our tactical tilts relatively modest and based on consensus, data-driven rationale, that we provide the greatest opportunity to deliver outperformance over the long run within a highly risk-focused framework. At McKinley Carter, we're very passionate about our process and care deeply about building portfolios to suit all types of clients. that these decision points are only valuable when made in consideration of our clients' personal goals and overall situations. If you're already a client of ours and have questions about this process, please let us know. If you don't currently work with us, we'd love the opportunity to tailor our process to your needs and help you take the next steps towards mastering your wealth.